Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the S&P 500 ETF, ticker symbol SPY. And as I do each and every week, I tell people to go back to last week's report so you can see how we built the trend lines, how we put out the forecast lines, how we calculated the angles of these forecasts. And when you do that, when you go back to the week prior and then listen to this report, you'll build your confidence in the reliability of these charts as a forecasting tool, as well as a risk management tool. So as I zoom in here for you, you will see that this line right here was the line that I drew last Friday. Again, this bearish engulfing pattern right here was what we closed with last Friday. And as a result of that bearish engulfing pattern, I said that we would most likely move lower, with the end of that line being my target. Now take a look. Today's low is within pennies of that target number. And I said that we would most likely go down to test this support level. So what does that mean for next week? Well, let's take a look and weigh the evidence. This is a fairly long and very strong red candle. So that tells us that the sellers were enforced today. There's still a lot of fear out there in the markets with regard to a possible secondary shutdown of the economy. While I don't think it'll be as severe as what we saw the first round, it is still sparking fear in the heart of most investors and even some traders. So that red candle tells us the sellers are enforced. Now going down to the volume here, I'm basically following our trader checklist. The volume supports the move. So we're seeing an increase in the volume today on that red candle. So that tells us the motivation level of the sellers is still in force. And you can see as I move down the chart, you'll see the stochastics is still heading lower. The CCI is still heading lower. And while that is now in an oversold condition, it's still heading lower. So the forecast is going to look like this. I'm going to erase all these lines, and then I'm going to redraw the lines according to what I see as new support. This level down here is a gap fill target that will most likely act as a support level. I think next week, because of this red candle and higher volume, I think next week we're actually going to go lower than the low back here on the 15th of June. So we have to keep an eye on that volume. If the volume continues to increase, then we could see even lower than what I've expected. And I'm even going to go so far as this with the end of line, my target right there at 292.28. So that's my forecast for the spiders. Now I'm going to hop right to the VIX. That's the volatility index, because the volatility index is the leading indicator, also known as the fear index. And last week I said that we would most likely rally on the VIX, and we did just that. Now I'll zoom in just a little bit further and then even magnify this candle right here. What is that? Well, that smaller body green falls within the larger previous red body, and that is known as a bullish Harami. So my target is right here on the VIX at 39.70. I'm going to erase that line, and I'm going to redraw it right up to right around that same target. I think the VIX is going to move higher. You can see that the stochastics down here is pivoting higher. You can see that the CCI is bouncing off of that zero line, signal line there. That is hinging to a possible upward move next week. All of that is bullish for the VIX, which in turn, because the VIX is inversely related to the S&P, that is bearish for the S&P. So keep an eye on the VIX. I believe that everyone should have that on their watch list and use it as a leading indicator, which is also an oscillating index. That's the VIX. Looking at a more broad-based index in the Russell 2000, again, I said we would move lower. That was my forecast line. We're not quite at my target, but I think next week we're going to hit that target. This is very close to a bearish engulfing pattern right there. That is when you have a long red candle engulfing the previous green body. And so that's bearish. Look at the oscillators still moving lower right there. So I'm going to simply shift that line over to the right, with my target being that support level for the Russell 2000, at which time I believe that once that support is hit, we'll start to see a pivot point, possibly bounce, and then maybe see some new long positions come into the market. Now, looking at the diamonds, that's the Dow Jones Industrial Average ETF. You can see that we came again within pennies of hitting that. And this too is following suit with the rest of what I've talked about with regard to the sellers still showing that momentum. You see this big long red candle on higher volume with the oscillators going lower, tells us that we'll probably see lower prices on Monday, maybe even Tuesday, with my forecast is a gap fill point. Look to the left here. That's an open gap. If you're following our gap trading principles, 80% of the time gaps fill. So I think next week that gap could fill, and then once it fills, I think we'll see a bounce from there. So there's my forecast lines. Again, we'll keep those in place for next week's report so we can see how that panned out. Now let's take a look at the Qs. This is more or less the tech sector. We, again, came within pennies of hitting my target, which is the end of the line right there. And we pulled back from resistance. Look right here. It's hard to see my red line there, but I'll highlight that in blue for you. I said early on in the week we would most likely go up to test this resistance level. Monday and Tuesday we did just that. And what happened? On Wednesday we pulled back from resistance and went right back to following my forecast line on the downside. Again, this is not my ability to have the ESP and read into the future. This is simply reading the price signals, weighing the evidence, knowing how to interpret those signals, and planning to profit from that, and also planning how to minimize risk if the position moves against you. This is not rocket science. It'll take you some time to learn these charts, but as you can see each and every week how accurate this is. We keep these free. I've made this free. I'm going to keep it free. However, I do ask that you hit the subscribe button so you get the notification when the next alert comes. I'd like if you could please hit the like button and then share this with everyone who you know is investing or trading in the market. Why is that important? Because if you can imagine 1 million people now following the signals and we're reacting simultaneously to those signals, these signals become more accurate. It's not any different than an analyst who has 1 million person subscription base and all of a sudden this analyst says, okay, we're going to raise our price target, or we're putting a buy recommendation in on that stock. What do you think is going to happen? That stock's going to go up because 1 million people are reacting to that signal put out by the analyst. Well, the charts become our own analyst. It's telling us which way the price action is going. And if we're reacting to that, we're all going to make a lot more money than if only 2 people are watching those signals. You follow? So please hit the like button, the share button, subscribe button, and we'll all stick together as a community of traders and investors while we all manage risk. So again, here is the price target. We're almost right on top of that. Higher volume, I think I'm just going to extend that out just like that. And I think we could even see a bounce at this support level down here. So I'm going to leave that in place. Wait for the CCI to start turning up before you have any buy ideas pop into your mind. All right. The momentum is still pointing lower. And as soon as that momentum shifts, then we could possibly take some new long positions. As an option trader, I am spread the market. What does that mean? I have hedged positions on. I will make money as long as the stock markets stay within a price range, and it's doing that. Our option Oracle subscribers are making money. We're having a great time. Don't be stressed by this. Embrace it, profit from it, and also manage risk from it. So those are the major markets that we've analyzed. If you want more of an education, go to the Market Guys website. Right there at the top of the page is a video link. I'll highlight that for you, magnify right there. There's a video link. You click on that, and it's going to bring you to the page that we have what's called Market Shots. Scroll down and review the 1% rule right there. Most important video on the page is how to manage risk. And just to the right of that, go through that short video. It's about 7 minutes long, and learn the gap trading principles that we promote. The 80-20 rule in gap trading is going to help you quite a bit. So that's it for now. Thank you so much for joining us. Again, I don't want to beat the dead horse here, but it's so important that you hit subscribe, like, and share. Share this on your social media pages, Twitter, Facebook, wherever. And again, help spread the good word that technical analysis actually works. So have a great weekend. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.